Good afternoon, ladies and gentlemen, and welcome to the weekly precious metals and commodities commentary. I'm Jeff Halley, market analyst here in OANDA in Singapore, and this is a run through of the CFDs available on the OANDA platform, and we'll have a quick look at each of them in turn and discuss what's been happening with them and where we think they might go, and also some market events this week. This week, in fact, is actually a bit of a central bank frenzy. We have the ECB, the SMB, the Bank of England, and the FOMC in the States, plus most of the Latin American central banks will also be doing rate announcements. Mexico will almost certainly raise rates. A lot of fluctuations there around the NAFTA agreements, and will they, won't they, with regards to the United States pulling out of it. That may well be a story running over Christmas, as is the race to get the US tax reform bill through before the end of the year as well. A lot of action over on gold, if we just head straight into that. Most importantly, I think I need to point out here is that this 1260 long-term support line finally broke last week, and we saw a lot of stop-loss action and reduction of longs in the market, and gold plunged $20 on the day actually. Since then, it has managed to rally back up to this 1252.5 resistance line a couple of times now, but has failed each time. So at no stage ever has it looked like regaining that 1260 region. This looks like more of a secular movement in gold, and perhaps a new trading range being set for gold. A lot of talk about rotation out of gold and into Bitcoin. Everyone's talking about it. I've yet to see any evidence of it, but maybe the price action's telling us something similar. I'm looking at the commitment of traders report, and we saw a massive reduction as of last Tuesday. It's a backward-looking report in gold longs, down 31% from the week before. Silver was down 61%, platinum down 24%. So definitely we've probably seen even more reduction of structural longs since this level broke, and maybe we're seeing some selling also in the physical and in the ETF market as longer term bulls throw in the towel. Where does this leave us now? Obviously we have resistance at 1252.5 in that 1260 region. Looking below, we've established a couple of daily lows, a minor one here around the sort of the 1240, what is that, the 1243.30 mark. And then over the last couple of days, we've established a marginal double bottom at 1240.5. Is it convincing support? Honestly, no, it is not. And in fact, when we look at the charts, we have to be honest and say there's a lot of clear air now, all the way down to around the 1205 region. We have to go all the way back to the July low in order to really see the next major support. We have an FOMC rate meeting this week. Tomorrow night they should announce a 0.25% hike. That's already taken to the bank. What will be interesting is if we see a hawkish statement from the Fed. If that's the case and the yield curve starts steepening, gold may come under pressure, as it may come under pressure if the irrational exuberance in the Bitcoin market continues. Futures have started trading in it now, and perhaps it's no coincidence that gold fell quite strongly on the day that the Bitcoin futures started. I guess the only saving grace for gold at the moment, if we come down to the bottom of the chart, is the relative strength index. The RSI is bubbling along at near very oversold levels. As those of you who've seen this video before know, I'm a big fan of RSIs on commodities and precious metals. They usually are a good indicator that we are at least going to get some sort of retracement. And in this case, we could see a retracement all the way back to 1260. However, the momentum doesn't look like being able to carry it. So in the absence of any other geopolitical events to change that outlook, you'd have to say that gold looks like a bit of a sell on rallies from a technical perspective. Silver tells much the same story. No good news here. We broke our 1654, immediately went to the next support level around the 1623.60 level. Once we broke that, again, we've tanked over the last week or so, and we seem to be consolidating at the bottom of this quite steep drop-off. Again, we saw a massive reduction in longs on the commitment of traders report as of last week. I would expect that to have continued since that report's data was gathered. Again, there is no real support on the charts except for this low here from late last week, last Thursday, at around 1562.5, and then it's clear air all the way down below 15 to 1492. The only caution I sound here right now is if we look at the RSI, we are in very, very, very oversold regions, which means we could have perhaps a bit of a pullback, a corrective bounce, possibly as far as 1623, although the chart suggests that would be ambitious. So it looks like just for now we could actually end up getting a bit of a dead cat bounce in the short term, but certainly nothing to change the bearish outlook from a chart perspective. Platinum, much the same story again. We broke out of the support at 920 and we've collapsed since then, took out this low way back in early October at around 904. Since then, there's a pattern here. We break supports, it tries to rally and fails. Breaks supports, tries to rally and fails. And right now we are at this very long-term support, 890, and we've closed 2 times below this now. Today we've seen a little bit of buying in Asia, but it still hasn't managed to recapture that 890 level. Again, sounding a note of caution though, that the RSI is pretty much near oversold levels, which could imply that we could get a corrective bounce back, but it's hard to see it moving past this 904 area. We have to squash the chart right up in order to get the next support. Rather than give you chart blindness, you just have to take my word that this red line at the bottom represents a low from way back in the start of the year. And we see here that's 811.30. So there's a lot of clear air on the platinum chart. So yes, we could get a bounce to offset that oversold RSI, but certainly nothing to change the secular bearish outlook that the charts are presenting. Palladium, of course, is a different story, being partially an industrial metal, partially a precious metal. It has been just a magical run all year on this, and rather again than squashing the chart up again, I will just quickly talk about the short-term price action. Definitely above $1,000 an ounce. It seems to be running out of puff a little bit, certainly above this 1,027. It's been up here a few times now, 2 over here, 1 up here, failed here and here. So I think it will probably take a little bit of new momentum in the market to make some significant progress to the top side from here. But you could have been saying that for the last 12 months and you'd have been proved wrong, but like most major share indices around the world. We can see that we did break out of this trend line, this 2-month trend line. We haven't managed to really close back above it with any sort of confident degree, apart from this close here on the, the 7th of December, which would imply that we will move down to this next support line, which is around 986 today. Behind that, we have the 100-day moving average, which is at around 953.60. And then we have this longer term support. You can see all of these daily lows around here where it tested and bounced off them. So it has had one little blip through, but never closed below it. That's a very good support line, this one. Comes in at around 906.82. And then this line that goes off chart is the long-term 1-year trend line support, 886.95. So let's call it 887. Excuse me, coincides with the 200-day moving average as well. So to be honest, Palladium could still fall nearly $130 and still be in an uptrend, but it does have a lot of wood to chop support-wise on the downside. Copper has been bouncing around on the nuances of the daily commodities market, so there's been really no clear trend going on, shall we say, in copper. We can see, though, after the big sell-off of last week, where we fell through the 100-day moving average and also support at 302 and at 298.60. Since then, our good old friend the RSI went oversold, and we have started making a bit of a dead cat bounce upwards. We've had a series of higher lows, and actually at the moment we have actually recaptured this form of support around this 297.20 region. We do have to get through this now previous support line, now resistance, and the 100-day moving average at 302. So that will be fairly formidable, I think. So it does look like it's lacking a bit of momentum at the moment. So I think this resistance on the charts will be quite formidable. Clearly, this low from last week at around 291.5 is first support, followed by this 284.70, and then the poorly drawn 200-day moving average today at around 281. Let's get to natural gas now. I almost jumped straight to oil there. I was so excited to talk about it. So anyway, natural gas has been interesting this week as well. If I look at the commitment of traders report, I can see that natural gas, the position changing in that has been down 30% from the previous week. So it was almost 170,000 contracts long on the futures market. Now we're down to 121,500 contracts. And I think this has been reflected in this pricing since we've seen all of last week. Sell, and that would be accounted for in no small part by the long liquidations we're seeing on the futures market. Also, it has been slightly warmer in the United States than it would typically be, which means that this should be running into the peak usage time for natural gas, for heating, etc., and that demand just isn't there because of the warmer weather. We do seem to be trying to make a dead cat bounce after breaking this longer term resistance here at 275. Whether we manage to hold on to that or not is up to some conjecture. We do have 285.60 above that, possibly capping any upward momentum. Bear in mind that the futures market still is very, very long, and usage is still not where it would typically be, and that there is a lot of natural gas on the world market at the moment. So I would think, looking at this, that there is a definite lack of momentum towards the upside. So it does look like a sell rally scenario here from a technical perspective. First support at 268, followed by now 253.60, this low all the way back there in February. Brent crude, things get very exciting here. So I guess the theme of the day for and what will probably carry on over the course of the week is that the Forties North Sea pipeline, which I'd never heard of before, has been found to have a hairline crack. The pipeline will have to be shut down for an indeterminate number of weeks. So what does this mean? Well, the Forties pipeline carries 450,000 barrels of UK North Sea oil a day from the North Sea oil fields. 80 to 85 oil platforms will have to be closed down. So when we think about the OPEC 1.8 million per day barrel, 1.8 million barrels a day cut, we can now add another 450,000 barrels on top of that, because the Brent crude benchmark is actually the North Sea oil is the main component of that. Britain will have to rush around the world trying to find oil everywhere to make up the lost production. So what's this happened here? Well, very interestingly, this pushed futures higher overnight, and today we are up at yet another 1.5%, testing the 66 region. But look what's happened. All these multiple daily highs at 64, at 64.45, 64.85, double top. You could call that a quadruple top, even more. 1, 2, 3, 4, 5, 6, 7 times. Okay, all been taken out, and now we seem to be moving straight up above this resistance zone. The next point in the charts, apart from today's high around 66, is the 69 region. So we only have clear air here now on Brent crude. This is definitely a developing story. This will definitely change the supply-demand narrative in the international crude markets over the coming days. These levels will now become support, plus this trend line here is now again support around 63. This is a major support, 61.25, 1, 2, 3, 4, 5, 6, 7 daily lows just on or ahead of that number. So this is a crucial level to hold. Behind there is 60 point, well, you could call that basically 60. also the long-term uptrend line. So actually now Brent crude could fall $6 and still be in an uptrend, and I think it is looking particularly constructive on the charts at the moment. That in turn has dragged West Texas intermediate higher. Britain will almost certainly have to source oil internationally. Some of it may come from the UK, from the United States. It hasn't obviously been dragged as high as Brent because it's a different benchmark. It's very much more domestically focused. But when we look at it here, this uptrend line from the beginning of October, we broke down through it last week. We do seem to be holding just under it now. We are crawling higher, higher, low, higher, low, higher, low. But we do need to break back above this line in order to get really excited about WTI again. Unsurprisingly, the Brent crude WTI spread has actually blown out to multi-year highs as well. Behind this trend line here at around 58.30, we do have fairly substantial resistance. 1, 2, 3, triple top at 58.90. But beyond that, the charts do open up to 61. So there's another $2 of clear air here if we do have a daily close above this. Down below, the first sensible support I see is around 56.5. The major support will be around this double bottom at 55.70. Okay, so now let's move on to the soft commodities. Not so much to talk about here this week, unfortunately. I guess what we're seeing here in sugar is a continued lightening of futures positions. Again, a big reduction in the futures longs actually over the course of the week. That was down by 19%. And I think what we're seeing here is perhaps the end of the ethanol rally story. There's been a lot of news in the States about them changing the requirements for ethanol blends and refining processes there. And what we've seen, I think, is a reduction of longs into a thin market. So we've broken the 100-day moving average here at 13.97. Let's call it 14 cents a pound. And then as soon as we've broken through there, we've had a big continuation all the way down today to around 13.60. This has all the hallmarks of a stop loss driven sell-off. The next support is going to be, if I can perhaps just draw a line on this previous low back in late September is really the most sensible line I can draw through here. You could probably get away with something around 13.30, but I think this is the first real sensible line around 13, and I like round numbers ahead of long-term support at 12.05. Of course, the 100-day moving average at 14 now will be fairly stiff resistance, I would think, followed by the 200-day way up here at 14.80, and which is also a series of daily highs. We are moving towards oversold territory in sugar, given the speed of the move down, but overall, I think, again, much like some of the metals, there will be a real lack of momentum on the top side in sugar as far as rallies go, and all of them will look somewhat corrective. Let's go now to corn. And again, with corn this week, as I look at the Commitment of Traders report, again, it's actually, we're seeing a bit of an increase here in the overall short position in corn, and I think that's what's been weighing on corn over the course of the last few days into the end of the week. However, when we strip out all the noise, we are still in a multi-month range trading scenario. So sort of up, down, up, down, up, down. It's almost like a sine wave, isn't it, really, over the last 3 or 4 months since the start of September. Like I said last week, lots of noise between 348 and 392.50. I think the important thing is to accept that we are in a range trading market with things like corn, and perhaps your strategy is to buy dips and sell rallies, leaving stop losses above and below these levels, and adopt a conservative and somewhat patient strategy towards towards trading it rather than try to get caught up in all the weekly noise on it. Let's look at the beans. This one's been interesting. It's teased me quite a bit. It's had breakouts to the top side, which have all failed, and I've had to rejiggle some of the lines on the charts here. We've had a false break to the top side out of what is now an almost symmetrical triangle over the last few days. There is still a lot of chatter about strong demand out of China for soybeans. Having said that, we did actually see an increase in the net longs in soybeans into the start of last week on the commitment of traders. So given that people have been buying and increasing speculative longs in the soybean markets and the futures, it is quite unnerving to see a series of lower lows on a daily basis over the course of the last week. So it could well be that the market is getting pretty long and wrong on soybeans, and we could now, given that we've had a false break and a failure out of the top of this triangle, we may now see an attempt at the base of this triangle. This line comes in at 268.70, followed by the 100-day moving average at 266.30, followed by the 200-day moving average at 962.70. So there is a bit of wood to chop on the downside here. But if we were to break through this line and perhaps through these lows around 955.90, 956, there is the possibility of an extension quite a long way to the downside with soybeans now. And this is particularly noticeable given that they have increased the long positioning in the futures, but the prices have gone down. And let's wrap it up with wheat. And wheat doesn't have a problem with long positionings because the futures market is well and truly short wheat. And that's not changed at all. That's unchanged from the previous week. There's lots of wheat running around in the world, record harvests in Argentina, and particularly the Eastern Europe and Russia, plus lots of wheat coming out of the States. Lots of wheat, not enough buyers equals lower prices, and that's really all you can read into this. That's a good reason why speculators are short wheat on the futures market, and that's because they feel it's going down, of course. The price action is certainly supporting that. We are now at long-term support at around 392.30. We did dip below it yesterday, but we closed just above it. Today, we are just treading water. So it's fairly significant. If we break through that level, we have to squeeze the charts all the way back to 2016 to see the next dips. And the next port of call would be 372.30 and followed by 367.40 all the way back in December of 2017. The resistance line comes through quite clearly at around 416.70, but really wheat does look like it has very few friends in the world looking at these charts and the supply-demand dynamics around the world. Perhaps, again, its only saving grace will be that the RSI is moving towards strongly oversold levels. Okay, so that wraps it up. I'm not sure if this is the last one of the year or not, but if it is, then I wish you all a wonderful holiday season. Stay safe, trade safe, and we will speak to you all again in the new year. Thank you, and thanks for listening in. Bye-bye.